What's up, dividend investors? Today is my favorite video of the quarter. You guessed it. We're reviewing Canadian banks. Dividend investors, bonjour. My name is Mike Héroux. I am the founder of Dividend Stocks Rock, and I'm also a passionate investor. I've worked 13 years for a bank in Canada, and then I move on to create Dividend Stocks Rock to help people invest with more conviction so they can enjoy their retirement. So I'm well placed to analyze those banks. Today we're going to look at the big six. I'm going to let you know what happened in their quarter. Some increased their dividend, which is pretty cool. We're going to look at valuation. Is it the right time to go in? We're going to talk about that Trudeau Tax. The federal government wants to increase the tax that banks pays, and we're going to wrap it up with a summary. I'm going to tell you which is my favorite bank. All right, so let's get started with the returns since the beginning of the year. So what you see on this chart is all the six banks, also with compared to the XIU, which is the TSX index. We can see that the TSX index at minus 0.5 right now, and then a few banks are a little bit higher, a few banks a little bit lower, but pretty much nothing. There's no place to hide here. It hasn't been a good 5 months for Canadian banks in general, so it is really the time where you sit down, you do your analysis, there's no rush, and then you just get your dividend and be happy with it. So let's go on with the results. The most interesting part is always the dividend increase and the earnings growth. So what you see on this graph is the results for all of them. As you can see, only one bank didn't increase its dividend. Does it mean that TD is in trouble? Actually, not at all. Keep in mind that some banks were increasing their dividend twice a year, so which is the case with CIBC and Scotiabank, and it's pretty obvious now that they're going back to this model. So I would expect another increase later on in the year. For TD, they usually increase their dividend once a year, so there's no panic there. The most generous one, Royal Bank and National Bank at 7 and 6%. BMO not too far behind at 4.5. And as you can see, kind of funny, but they're the most generous, but they also show the best payout ratio. I just want to highlight one thing. They're all super safe, regardless if you want to even invest in CIBC or Scotiabank for their higher yield. You're still investing in a very major business that is running into an oligopoly and shows a payout ratio under 50%. So it's still the best of both worlds. But when you look at companies like Royal Bank, TD Bank, BMO in the low 40s, and then even National Bank at 36, this is kind of crazy. This means that they have plenty of money to invest in new projects and still reward their investors. A quick note on earnings per share, and we're going to look into the details right away. But as you can see, it goes up and down. It is a wide range of earnings. We have TD and CIBC at down by 1%, which is not catastrophic, but compared to Scotiabank and National Bank up by 13 and 15%, this is kind of crazy. So you can see that depending on how they manage their portfolio, depending on how they manage their different business segments, there are some difference among banks. It's not because you're buying one bank that you're safe. You have to do some digging. So speaking of digging, let's take a look at the results per segment. So I've highlighted some in green and some in red. The others one are pretty much stable. What you can see on this graph is in general, personal and commercial stands for PNC. Across most banks did very well. So we have BMO, Royal Bank, and Scotiabank that are double digit. The story is always the same. They usually look at their provision for credit loss, PCL. This means that they look at their loan portfolio and they determine the likelihood of default. And if there's some likelihood of default, they will increase their provision. That hurts their earning, but not their cash flow. And the next quarter or the next year, they look again and they say, oh, well, you know what? We're still getting paid. So it's taking off the provision for credit loss, and then it boosted earnings. So in general, you have to dig a little bit further. You have to read the press release to understand if there was like more volume than PCL. In this case, we all have a little bit more volume across all banks. This is a good thing, but the only thing is The only difference will be if there's lower or higher PCL. So as you can see, CIBC took a deep dive, minus 18% for that quarter, but it's only resulted in 2 PC because of a higher provision for credit losses. So nothing alarming here. It's just like sometimes the timing in their review. Remember, during the pandemic, Scotiabank were the last one to issue higher PCLs. So they look better the first quarter, and then the second quarter they will look worse, but in the end it comes out to the same thing. A few interesting points here. National Bank with US and international up 18%. So they have created, through acquisition, Credigy and Aba Bank in Cambodia over the past few years, they have created this new business segment. It's doing very well for them. Higher revenue also for capital market. As you can see, this is quite volatile. We go from minus 26 at Royal Bank up to plus 17 at National Bank. So for this one, take it always with a grain of salt. Sometimes it's really good, sometimes it's really bad, but over the long trend, that is important. Usually it's highly profitable, but you're going to hit a few bad quarters along the way, such as Royal Bank. They had lower volume, they had a bad experience with fixed income, and there you go, boom, they're down 26. Another interesting point here was Scotiabank with international market up 44%. And then you're thinking, oh, is it finally the year that Scotiabank will up with this narrative that they will grow faster than other banks because they have international exposure? Well, not really, just about lower provision for credit loss once again. So overall, good results, but depending on the bank that you have, it has different impact depending on the segment. Now, looking for the price earning ratio. Some people are just saying, well, banks are over expensive, it's not the right time to invest. Well, I wanted to show you on this graph the PE ratio over the past 5 years. As you can see, it's relatively stable, around like 10, 11, it's pretty much a good number. Right now, we're not that high on the scheme of things. So it is definitely a good timing. As you can see, Toronto TD Bank is the highest value right now, so the most expensive probably, along with Royal Bank. And then at the bottom we have National Bank and CIBC. CIBC, they lack of growth vector, they lack of a clear strategy. They don't have like that. Okay, so BMO is about capital market, National Bank is about diversification, Royal Bank as well, TD Bank is about US, Scotiabank is about international, CIBC is about doing banks. You know, bank stuff. They lack of special identity, and they usually grow a little bit lower, like slower than other banks, and this is why they have a low PE ratio. For National Bank, that explains because they're smaller. It is more volatile. So at one point, some investors are still not ready to get their feet wet. They should have. I've been telling you for a long time, even though not financial advice, but I'm just telling you, I'm cheering up for National Bank most of the time. But as you can see, low PE ratio, which is interesting. If we move with the PE ratio forward, we have this similar story. So Toronto Dominion Bank and Royal Bank are the most expensive, and National Bank, BMO, and CIBC are the least expensive. Again, I think that at this point, being for a company that is operating in an oligopoly that pays at least a 3.5 and 4% yield, that offer dividend growth, that offer a low payout ratio, and some decent growth overall, it's really hard to go wrong with a bank. So keep that in mind. Do a little bit of digging, but it's definitely the best banks in the world, in my opinion. Now, a lot of investors are concerned about the Trudeau tax. Within their next budget, they said, oh, we're going to tax more. We're going to introduce the, I think it was like what, the Canadian Dividend Tax Bank or something like that. Anyway, long story short, they want to increase the taxes that banks pay because they feel that they're overprotected by federal, which is true. They have like great rules that allow them to play on their playground without getting any worried by anything else. But at the same time, there's a price to pay, and they're just like, hey, we need money. We printed so much. Now we're going to get some of that money back. I've went into the transcript to have some information about that. Most of the time, you're not going to find that into press release or into investors presentation because they're going to try to put them on a good side and try to avoid discussing bad topics as much as possible, which is kind of like a marketing a marketing operation here. The only quote I was able to get was from Nadine An, which is she's the CFO of Royal Bank, and she says, you know what? We're still not in front of that bill that we have to pay. It's still yet to be drafted, to be completed, and then to be passed. So we're gonna wait. We're like definitely too soon to discuss this topic. Most others bank transcript I've read has no mention about the federal tax that will increase. So overall, they're just gonna wait and say, you know what? At this point, this is noise, and we're gonna see what's gonna happen later on. But for now, I don't really care, and I don't really want to talk about it. So what do we have learned in this quarter? Well, we learned that business is back to usual. Some banks went back to their twice dividend increase a year. Some banks did better than other, but it's not like a big thing right now. No one is in trouble. So each bank reviewed their portfolio, and the provision for credit losses has a major impact on their results, either good or bad. So take it with a grain of salt. Capital market, sorry. High volatility, never count on that for the long-term growth. But still, it's nice when you have a good quarter. And CIBC had its splits in May. As you can see, had not outperforming the other banks. I know it's really short term. It's just been a few weeks now. But keep in mind that we're going to talk about that split in a few quarters as well towards the end of the year. And I still have the same conclusion. You know, instead of having two shares, you have, instead of having one shares, you have two shares, same price, same dividend. Nothing has changed. It's just a marketing operation, and it's just good if you want to write covered calls, for example, but that's pretty much the only good side that you're gonna have. Finally, banks are still cheap in this kind of weird market where there's a lot of nervosity, there's a lot of volatility. We are entered in a bear market actually. So this is a place where you can invest and get the money back, get long-term results. So I would put my $2 on Canadian banks. And if you want to have more tricks on how to review a portfolio right now, which sector would be a better fit in your portfolio, and how you can navigate through this possibility of having a recession. Royal Bank said there's a 50% chance of having a recession in the coming quarters. Well, if you're afraid of that, just download my free workbook. It's the DSR Recession Proof Portfolio Workbook, 75 pages of crazy content. You don't have to be a Dividend Stocks Rock member to use it, even though it has been created for them. You can use it, you can review your sectors, you can review your stocks, you can identify which losers you should sell and which losers you should keep. All of that to give you more conviction in your investing plan and to help you in your investing journey. So I hope that you have enjoyed this video. I am curious. Let me know in the comment below which bank is your favorite one. Obviously, on my side, still National Bank. As you can see, I keep telling you guys, it's the best bank, but you know what? Results speaks louder. They show double-digit earnings per share. They show a 6% dividend increase, and they have the lowest payout ratio across the board. All of that for the second cheapest stocks among the big six. I think it's a pretty good deal, don't you think? So let me know in the comments. Give me a thumbs up. Follow this channel for the next video on the next Thursday. And until then, don't forget to stay invested.